Corporate Finance Core Topic 5, Learning Objective, and that's NPV and IRR, and Learning Objective number 3. We're going to compute investment after-tax levered cash flows, also called free cash flows to equity, and investment measures related to those compared to the FCFEs. So let's talk about levered investments and cash flows. We're now going to evaluate the impact of financing the fishing charter with a loan. We'll then compare the investment measures, FCFF, unlevered, and FCFE, levered cash flows. And just a reminder from topic 2, our unlevered cash flows, FCFF, are my EBIT after tax, earnings before interest and tax, minus the tax, using the tax rate, plus depreciation, minus CapEx, minus changes in net working capital. I just added in here, plus salvage, since we're using that concept now. That's kind of the other flip side of CapEx if you have a resale value. Now FCFE, equity cash flows, they're not going to be EBIT, it's going to be earnings before tax because you're going to subtract interest first. And EBIT, earnings before tax minus tax, has another name. That's actually net income. So it's net income plus depreciation minus CapEx plus salvage minus changes in net working capital. And then some more adjustments for FCFE. I want to show all the debt cash flows. So if I get a loan, I need to show that as a proceed. If I pay off a loan or have a principal payment on a loan, I need to show that as an outflow. So we're going to calculate our FCFE of our fishing charter investment. So we're going to go to the spreadsheet, and I'm going to assume that I'm going to get a loan for my $159,000 boat. I'm going to get a $149,000 loan. In other words, I have a $10,000 down payment. And I'm going to finance that using a 10-year loan paid monthly, has an 8% APR. So notice we're kind of using stuff from every topic almost so far. So I'm going to jump to my spreadsheet. And the first thing I want to show here is I want to calculate the loan payment. So the loan payment, I'm going to use my payment function, PMT. It says rate. Now this is a monthly loan, so my rate is 8% divided by 12 is the monthly rate. Number of periods, that would be 10 years times 12 months, 120 payments, comma, present value. I'm going to put a negative 149 in there because I want the number to kick out as a positive number. And then I will finish that. So it's going to be a monthly payment of $18.19. And I want to do a payment schedule down here. So my $149,000 loan has a beginning balance of $149. And in the first month, I'm going to pay some interest. I'm going to pay 8%, anchor it, divided by 12, anchor it. So that's my monthly interest times my beginning balance. So I'm going to pay $999 in interest in that first monthly payment of $18.19. The principal payment must be $18.19, anchor that, minus the interest component is $819 is the interest, or sorry, is the principal component. So my ending balance for the loan after the first month, or my payoff value there, is $149 minus the $819. So there it is. Now the balance at the beginning of the second month is that $149. And then I can copy these formulas down if I anchored them correctly, and then copy this down for my 120 months and make sure the last value in month 120, the ending balance is 0. That means I did it right. Otherwise, I got to figure out what I did wrong. And there we go. The 120th payment is $1,807 beginning balance. I pay like $12 of interest, and it exactly pays off the loan. So I'm going to go back up to the top. And I think I have everything else done for you. So let's try to get to free cash flows to equity. What are the cash flows out of my pocket? I'm the owner of this charter. What are my out-of-pocket cash flows with the loan? So notice in yellow are the additional line items. Notice I have a sum. This is the first 12 months of interest, second 12 months of interest, and so on. So I now have interest expense, which gives me net income. So my earnings before tax was $20,000. My earnings before interest and tax is $20,000. My earnings before tax is only $8,000, which means my net incomes are much lower. But on the flip side, I don't have to put as much money out up front. So let's see what I did for that. So there's my net income. I want to get to free cash flows to equity, so I'm going to add back depreciation, subtract CapEx, minus changes in net working capital. Notice this is the exact same thing I did for free cash flows to the firm. However, this little row I threw in here, this is the loan principal. So when I get in period 0, I'm going to get $149,000 from the bank. However, each period I'm going to be paying off a portion of that loan. And notice these are the sum of the principal payments for the first 12 months, second 12 months, and so on. So these are the payments of principal. And then I have the last formula here is the last year's principal, last 12 months of principal. Let me go down and see what it's referencing. It's the last 12 months of principal plus the ending balance at the end of the 8th year. Since I'm this project, I'm going to pay off my loan at the end of the 8th year. So my total cash flows from the bank, I'm going to receive 149 and then I'm going to pay off that. Notice if I sum up this right here, these back to the bank, this is always a way of making sure you got it right. Notice I'm paying off 149.9 of principal bank to the bank, and the bank gave me 149, and I'm also giving the bank this interest. So that's a good way to say if you got this part right, is the principal paid off. So now these are my free cash flows to equity, net income, take care of my depreciation, CapEx, salvage, working capital, loan. Those are my equity cash flows. So if I got a loan, this is actually what comes out of my pocket compared to if I did this project with no financing. So let's take a look at that. With no financing, I have to pay $165 today, and then I start generating $30,000 a year. With the bank loan, I only have to put out $15,000 today, but then I only generate, say, $12,000 a year. So that's the difference with this with financing. I'm gonna have a little less cash flow, or a lot less cash flow today, but then a lot less cash flow are going to be incoming in future years. And then I calculated the average accounting returns of unlevered. So it's right here, unlevered. And then the levered model. So free cash flows to the firm, free cash flows to equity. The average ROA goes down for average accounting return. Reason why there is my net income is lower because of interest expense. My payback period goes from 6 years to 2 years. Since I only spend $15,000 today, it doesn't take long to break even. I'll put the same required rate of return to calculate the NPV. The NPVs are much higher, from 11,000 to 47,000, which then makes the profitability index much higher, 4 times higher, and makes the IRR much higher. So the question is, should you finance this project with the loan, or should I do it without debt? Well, that's a hard question to answer. It seems like it's a no-brainer. Use the debt. I use less money today, and I get higher rates of returns. Actually, if I had $159,000 to spend, and I only need to spend $15,000 with the bank loan, why don't I buy 5 boats or 10 boats? That's the allure of doing this financing, is I could scale this project and make it really big. Here's the problem with the equity finance. Nowhere here is capturing the risk. This debt finance project, with that loan, this is much riskier than having unlevered. Think about the 2020 with the COVID and what that did to boat charters. So I could have gone bankrupt in 2020 if I financed it with a debt. Because if I just went here and say, well, what if I don't run any charters in 2020 and that happens for a couple years? Let me see what would happen. I have some fixed expense. Let's say I go 2 years with, or 1 year with no revenue. So I'll take out those two numbers. I'm down $22,000 at the end of the first year, and I still need to make these loan payments. So I could go bankrupt. What if I had to go 2 seasons? Or maybe next year's season's just a little bit off because people are still a little nervous. So whenever you have debt financing, you have fixed costs. You have fixed costs in interest expense, and if you don't pay it, you either come up with the money later or you're going to go bankrupt. So I can't really say that these higher rates of returns are better. I'll just say that they are, well, they are better, but they are riskier, so it's not clear what I should do. What is clear is if I want a debt financed project, I should probably require a much higher rate of return. And next, and future topics, we'll talk about the effects of leverage and what rates of return you should require for different levels of leverage. So that's when we talk about the weighted average cost of capital and CAPM. We'll talk about that. So that kind of answers the question. Should I use debt? Well, I don't know. It depends on how risk averse you are. It does seem better if things work out, but be ready to go bankrupt. So let's talk about free cash flows of the firm, unlevered cash flows versus these equity cash flows. Both provide important insights into the investment cash flows. I like to calculate them both. Even if I'm going to finance it with debt, I want to see what it would look like for unlevered, to see at an operating level without debt, is it profitable? So FCFF is the cash flows generated excluding debt and interest. FCFE is the cash flows including debt and interest. Both FCFE and FCFF account for operating profit, taxes, CapEx, depreciation, and investments in working capital. The difference is the FCFE, the initial outlay, is lower because of financing. FCFE, the future cash flows are also lower because of payments of principal and interest expense. The FCE, IRR, and NPV are often higher. And as a rule, the NPVs and IRRs of equity or debt finance projects are going to be greater when the after-tax financing rate is less than the discount rate. So there's a relationship between what happens to my IRRs and NPVs. It depends on the discount rate versus the loan rate. So the answers would be quite different. In my example for the boat, my discount rate was 12% and my loan rate was 8%. So what would happen if I made my loan rate 15%? Well, I could try that. So if my loan rate were 15%, well, let's just make it 20%. Notice how these are not looking so good anymore. This is not updated, the payback periods. So things are looking pretty bad depending on that loan rate. So maybe part of your analysis is, can I get a decent loan rate? And how does that compare to my discount rate, the rate I should require for the risk of this project? All right, so this topic, we calculated after-tax levered cash flows, FCFE, and tried to think about how they affect our investment measures of NPV, IRR, and others.